Good morning, everybody. Welcome. We'll just we'll let a few more people join, and then I'll hand over to Barry, who's starting proceedings for us. We'll just take another minute or so to see who else is joining. I feel like we should have some hold music of some kind at this point. Okay, well, I think that's probably given people enough time to join. So I'm going to hand over to Barry Murphy.
Thank you, Lloyd, and thank you all for joining us today as part of this year's Business Finance Week. This is the second year that Business Finance Week has taken place. Last year's pilot grew from a seed idea of a small collection of themed events and became an events and communication campaign with more than 60 partners, reaching thousands of businesses across the UK. This year, today's event is one of 27 taking place across the UK, and of the 27, 16 are taking place in person and 11 are webinars. I'm delighted to be here today to open today's event, which is focusing on maintaining healthy levels of working capital as part of today's campaign theme, Thriving with Finance, Unlocking Your Working Capital. My name is Barry Murphy, and I'm the Managing Director for Risk and Compliance at the British Business Bank. We are a government-owned but independently managed economic development bank. The British Business Bank is committed to breaking down the disparities in access to finance for smaller businesses across the UK's nations and regions. Business Finance Week brings it's a great opportunity to work collaboratively across the business support community to really help smaller businesses find out more about different finance options that can make a difference to them. Businesses who attended last year told us that they left feeling better informed about the finance options available. 7 in 10 planned to either find out more or to access finance as a result of the week's activities last year. Businesses who attended those businesses that attended have so far gone on to secure more than £15 million in finance. So we can sort of see the impact that this has. We're aiming to build on that through today's event, which brings together some of the Southwest leading finance providers to raise awareness of working capital options and to provide an opportunity to learn from the speakers' expertise. We know from our research that this sort of session is very much needed, as significant numbers of smaller businesses report not being aware of their finance options and the finance providers available to them. So over the next hour or so, there will be opportunities to hear about the different forms of finance, engage and ask questions of our speakers, and hopefully come away better informed around the working capital options for your business. So I'm looking forward to hearing from all our speakers today. Thank you for being here as part of Business Finance Week, and let's get started with the session, and I'll hand you over to Lloyd now. Thank you.
Thank you very much, Barry, for kicking things off. So we are absolutely delighted that you joined us today as part of Business Finance Week. And as you can see from the next slide, we've got events all over the country, and as Barry's just mentioned, 27 of those across the whole country. And we've themed each day, as the next slide will show you. Thank you. So we started the week looking at startups on Monday, And then yesterday we were busy looking at exploring finance options for growth, although we do have some overlap with that topic today, obviously, because working capital is vital for growth. And then today we're very much looking at this topic around unlocking your working capital. And there's further sessions, as you'll see on that slide, carrying on throughout the week. So do if you haven't already done so, take a look through all the events that are on offer. And we're getting really good engagement and really good feedback already. So it's been a fun week for Ed and I, who are hosting you today, alongside Barry. So let's think about this topic, and I'm going to move to some of our expert speakers in a minute, and I'll show you the agenda in a second. But let's just have a very quick thought about working capital. It's really a vital thing to be thinking about in your business. We all know that looking at your cash flow position and what demands that's making on your working capital position is really going to make a difference to how you can progress or continue even in your business. And I'm sure we'll hear from some of the speakers that, especially later when we get to the Q&A, it can be a particular challenge when you're growing a business as well. It's something that comes to the fore at that point. In terms of the impact of sort of working capital on your business, it really goes across everything, all the financial aspects of managing your business. If you're looking to expand, then you're likely to have increased costs as you take on more customer orders. You've got that important point where you're paying staff at the end of the month on time. You've got the cash flow of managing the incoming and the outgoing expenses, and when you get paid, and all those pressures. So whether you've got enough capital in your business to make all that work and to make the business work is absolutely vital. And what we're going to look at today through a range of speakers is some of the options that you can consider to help you with those challenges in your business. We'll also give you the opportunity to ask each of our expert speakers questions later on after they've talked. So if we can move on to the agenda slide, please, Ed. So just bring up that slide in a second.
Should be seeing it now, Lloyd.
Oh, thank you. It's just beyond my view. Thank you very much. Yeah. So there we go. There's the rough agenda for today, and we've got some really great speakers here today. We've got Steve Mayle from Swig Finance, and he's going to be talking to us around loans and telling us a little bit about his organisation. We're then moving on to hear from Nicola Hambley of Ignition Credit, who's going to talk to us around the topic of asset finance and other related options. And then focusing around invoice finance, we have Anthony Purse from Optimum Finance. And we'll then hear from Louis Spencer from NatWest on topics such as overdraft and trade finance. And then, as I say, you'll be able to ask them all questions. You'll find the question tab available to you there. Please do go ahead and put questions in. I'm sure some of them may occur to you as our speakers proceed. So let's get going without further ado, and let me introduce you to Steve Mayle.
Good morning all, hope you can see me. Thank you for coming along today. So I'm going to cover off loans. This is a wide topic area. There's multiple lenders out there. They all operate with different criteria. Some have got credit scoring. And I think today it's just giving you an idea of perhaps the first point of contact to look at borrowing money, and what people like Swig Finance, my company, can do differently. So I think the first thing to understand is the first point of contact for lending should be your bank. And if you can just flick to the next slide, please, Ed. Okay, so with banks and loans, you've generally got at the SME, micro, small business level, you've got a credit scoring criteria. And this takes into consideration many things. So the sector, so if you're in retail, hospitality, perhaps these aren't favoured by the banks. Perhaps you've had a financial event that the computer system won't understand, but will see as a negative, and that might stop you accessing funds such as loans. So Swig Finance, then, just to introduce us, we are a community development finance institution, a CDFI. We all come together under responsible finance. There's 50 of us, at least 50 of us in the UK. So we're not here to compete with banks. We're just another alternative that gives the SME community access to different types of funding. So today I just want to whiz through. I've got 10 minutes, I think. So we've got questions at the end, and please feel free to drop in any comments or questions you've got, and we can answer those later on. So what makes us different then is that we are we don't credit score. It's a relationship approach to lending. You could say traditional, old-fashioned, some would say, but it's a traditional method of approaching finance. So we want to know about you. We want the story. We want a little bit of a CV about you. We are looking at a detailed business plan with a cash flow forecast in support. So where you've been rejected perhaps by a bank, or you've got poor credit, we are willing to sit down face to face with you and understand the situation. And we can, it has to be a viable application, but we have options to, we don't use credit scoring. So we want to know that story. That's what brings it to life for us. And it's about the social impact of lending. So really, part of my job today is to let you know that if the bank says no, there's other ways that you can access finance. So yeah, we focus on the business plan, cash flow forecast, jobs, sustainability, the environment, and we're looking at the effect on the Southwest, the social impact of our lending. So we have our own funding. Some of it we're connected very closely to the British Business Bank and Triodos Bank, for instance, so on an ethical basis. And we've got plenty of funds to lend. So we've been lending over 30 years in the Southwest. Next slide, please, Ed. Thank you. So we publish our social impact report. If you go onto the Swig Finance website, the link is there. It'll tell you we're using the 17 UN Sustainable Development Goals. So we're putting all our funding into sections. And the people that fund us want to know the good that our money is doing for the local business environment, so the Southwest. So we cover all of the Southwest. So we've lent 10.8 million was the year before. Last year we were 14 million to 414 new startups and growing SMEs in the Southwest. So a significant amount of money. And since April 2019, we've invested over nearly 70 million pounds to over 4,000 businesses in the Southwest. So we are a significant player within the business funding environment. So we support viable businesses. And what's viable? Well, we'll look at where you've come from might not be viable, but lending you money and for things like working capital can turn you into a viable business. So it's about how you present that to us, and it's about your cash flow. So again, we're not just looking at how much money we're making as security of our lending. We are looking at the good that is done to the local community. We want to see shops open in the high street. We want to see businesses employing new people, paying existing staff, and continuing to trade. That's our goal, really. And this is probably what differentiates us from other non-CDFI lenders. But just bearing in mind that we come in behind, on most of our funds, we come in behind the banks. So you should approach your bank first of all for funding. Next slide, please, Ed. Okay, so I talked about lending 14 million pounds. we're looking at, so you can see sections on the bottom left there, women in business, 40% of that was to women in business, new startups created, jobs safeguarded over 1,000. So there's significant numbers here. And about £14 million, there's a very technical calculation that goes on, but basically the impact of the Southwest on that 14 million lent is 44 million from tax paid to people paying VAT, buying stuff, paying mortgages. So yeah, we're really interested in working with businesses to keep them either startups or to keep them trading as viable ongoing businesses. And you see our goals on the right hand side, 3 of them there. We just want to help the local communities thrive. Next slide, please. Okay, so I've got a couple of products and I'm going to have to whiz through these because I'll run out of time otherwise. But on my side, we've got business loans. We can lend up to £250,000. On a generally an unsecured basis and no tangible security, no charges over houses. On the SWIFT fund, the Southwest Investment Fund, which is new from July, we're the delivery partner for up to £100,000 on that fund particularly, but that can be used for startups as well. So that's another way of accessing funds if you're a brand new business. So on the business loans up to £250,000, limited companies and CICs, they want to consolidate or grow. So you want working capital. We've got debt finance we can fund, or debt refinance, sorry, staff and premises costs, capital purchases. So our funds and some bank funding, and again, it depends on the lender. So this is very generic, but certainly for us, we can look at working capital as a use of funds for our loans. So we're going to ask for personal guarantees and a debenture. The personal guarantee is unsupported. I don't want to get too technical now, but it just gives you a flavour. So forecast led again. So we're really trusting you, your business plan. We want an 18-month sort of minimum forecast. It's going to be charged at 12 over base rate. And we know that base rate, although it's stabilised at the moment, has increased over the last year and a half. There's a 5% fee and a 5-year maximum term. And you'll have to make your own mind up about whether you feel that's expensive or not. But until you've actually approached a bank and you've been offered finance, I think we're very open and honest about what our funding costs. So again, you approach your bank, see what is offered, look at our competitors. But yeah, I mean, I don't think that's a million miles away from what the market's charging at the moment. So, okay, and I've talked about SWIFT startup loans at 100,000. So next slide, please. So startup loans now from £500 to 25,000. So we're a delivery partner again for the startup loans. And although it's a startup loan, it is for businesses trading under 3 years. So say trading, that's in bold. So if you registered your company in 2015, but you didn't start trading until 2021 and earning revenue from your business, then you can qualify for this. So that's an interesting point because a lot of people think that they're not a startup. So from your date of trading, again, this can be used for working capital and it's applicable for sole traders, partnerships, limited companies. And apologies if I'm rushing, but we've got to keep this to 10 minutes really, and we've got lots of time at the end for questions. So whereas before it was a loan to a business, this is a personal loan for business use. So a maximum of up to 4 applications for the business, up to £100,000 is possible. So significant money. Unsecured again, 6% fixed interest rate, no fee, 5-year maximum term. And I've put a link in there that if you want further details, you can find them. The British Business Bank have got their own site as well for that, and we can put all the links up to this later on. So we work in partnership with them. So very flexible. So it's possible to redraw the loan within the term it says there, but actually 5 years from the date of where you traded. So if you pay back, take 25,000, you pay back 15, within a certain period, you've got the ability to redraw that. So very flexible. You can draw it in a couple of tranches at the outset. It can be repaid without penalty. Next slide, please. Okay, so I'll put on there that we understand the access to finance is one of the biggest barriers for SMEs and startups today. So we're very happy. Remember, banks should be your first point of contact, but there'll be many reasons why you need to speak to us, and we're very happy to discuss My contact details are there, but also visit us at the website, Swig Finance, and we are very happy to discuss one-to-one your funding requirements. I thank you very much for your time, and I will remain on the call for questions later on. Thank you.
Steve, thank you. I do have a quick question for you, actually. So I was really pleased that you mentioned startup loans, and it's a very high impact product for us, actually. It makes a lot of difference in the marketplace. I suppose if you're an early stage business in that sort of first 3 years of trading, thinking about your working capital is probably going to be a really important thing to do. And there are other aspects to, there are other reasons for looking at startup loans as well, around mentoring and access to resources as well. So I just wondered if you could speak to that sort of topic briefly.
Yeah, so I'm not on the startup loan team, but it's very it's a credit scored entry into that. So first of all, even if you've had poor credit, we see a lot of businesses or individuals getting onto the startup loan scheme, and the use of funds is wide. So working capital is certainly a part of maintaining a healthy bank balance, and to allow you to trade. Staff costs, as I mentioned before, premises costs, education costs, that sort of stuff. Really, it's all about how you present your application. But certainly with us, there is other providers as well for startup loans, but we are probably the largest provider in the Southwest. It's about understanding that viability of the business and understanding what the use of funds are. So it's very broad and flexible what we're allowed as a lender, what we're happy to lend money on. And again, I'll just remind you, it's that viability side of things. It's got to be not beyond doubt, but you can bring a lot of energy to those applications because it's you. We're funding you and your business, and we're really interested in it succeeding. So. Great. I hope that answers your question, Lloyd.
Yes, great, and also just to highlight the mentoring service that can be attached to a startup loan, and the resources that you can tap into from the Open University as well. I think it's not just the money that you get access to there as the something that's worth highlighting. So let's move on. Let's go to the next slide, please, Ed. Thank you very much, Steve. And now we're going to hear from Nicola Hambley, who is a Senior Director at Ignition Credit. And she's going to talk to us about asset finance and how it can assist with some of the pressures that businesses can be encountering. So, Nicola, I'm going to hand over to you and move off the screen. Thank you.
Thank you very much, Lloyd, and good morning to everybody, and thank you for joining. And as Lloyd has kindly introduced me, I'm Nicola Hambley. I'm representing Ignition Credit today. And I'm going to talk through asset finance and how that can help you with some working capital pressures. So Ed, if I could have the next slide, please. Thank you. Okay, so first of all, who are Ignition and how we can help? So we are a finance broker, but we're a little different that we're also a lender as well. So by that, I mean, we're able to lend our own funds as well as have quite a panel of funders out there to assist customers. So that works for us very well because it means we've got greater flexibility in providing solutions to all of our customers. We're based down here in Truro, and you can see on this rather large map of the UK here. However, we do cover nationwide. So we specialise primarily in hire purchase and lease finance. And some of our main sectors include, which I've listed here, construction, transport and logistics, renewable and green energy has become a really huge sector at the moment, manufacturing, hospitality, very key to our mainly local areas down in the southwest, vehicle finance, specialist and classic cars. Ed, if I could have the next slide, please. Okay, so first of all, what is asset finance? Asset finance is a way for people or businesses to get the things they need, like equipment, vehicles, or machinery, without a large upfront cost, and it can be tailored to fit the budget and seasonal trends of the business. And what I mean by that, to bring it to life a little bit, is it can be from as little as the knives and the forks that we use when we eat in a restaurant, through to the IT, software and hardware that we all so heavily rely upon these days, and all the way through to large plant and machinery. And the levels of business that we write here can be as little as £2,000 all the way up into the multi-millions. So it really does cover everything, and the PowerPoint presentation would be too long if I listed all of the assets. So I'm just going to talk through some of the benefits of asset finance now. So preservation of working capital, and this is what this presentation is about today. We want to make sure that you can keep hold of your working capital to use for things such as your operational expenses, payroll, your marketing, expansion, anything like that. So when you're needing to buy some really business critical assets, asset finance can provide you with that solution without you needing to tap into your working capital. Access to modern equipment. And what we mean by this is the latest equipment all the time is what businesses want, but they also come with a cost. So with that, we're able to remove that concern from you that you don't have that heavy outlay, and we're able to provide you with an asset finance solution that can still enable you to buy those business critical assets without that actually coming out of your working capital. We do have industry specific needs, and some of the sectors I talked about on the previous slide, such as manufacturing, transportation, construction, they heavily rely upon expensive equipment, and therefore they heavily rely upon asset finance to maintain their assets and keep most up to date with it. So flexibility, and this is one I really wanted to talk about because it's probably not known out there how flexible the asset finance product can actually be. So first of all, VAT. We provide VAT deferrals, and what that basically means is VAT comes on top of an asset that you're buying, and that can still be quite a chunk of money out of your cash flow to have to find until you've actually reclaimed it back from the HMRC in your return. We are able to provide VAT deferrals, which means we're paying for your VAT upfront and allowing you to not have to repay that until you have reclaimed your monies back from the HMRC. Again, that's taken some pressure off your working capital. Seasonal payments, probably not known so much out there, but as I alluded to in my previous slide, seasonal payments really can assist some sectors. And for instance, down in the Southwest, we're very big on hospitality. Now, that has peak seasons to it. It's very busy in the summer. It's much more quieter in the winter. And therefore, that is where more cash flow pressure comes from. So rather than 12 equal monthly instalments, as you would have with a general loan over the year, we are able to tailor to some industries, such as hospitality, agricultural, that we actually provide larger payments in the months where your cash flow is much stronger, and then we reduce them in the months that the cash flow is at a bit more of a strain, and therefore helping you with your overall working capital. Balloons is something else that probably most are aware of when we look at putting a balloon on a vehicle, but actually we don't just stop there. We can also provide balloons on plant and machinery, and therefore that helps with the overall monthly cost, particularly if you're looking at purchasing a particular asset to help with a project. That can keep your costs down, and then it can still have a residual value at the end. Now, we are also a provider of unsecured commercial loans. Now, that can also be used for providing funding for VAT and corporation tax funding to help spread those payments more evenly for you as opposed to an upfront cost. We also use unsecured commercial loans as part of complementing our overall asset finance product. So tax efficiency. Asset finance arrangements can offer tax benefits, as leasing and hire purchase payments are typically tax deductible expenses. There's various schemes out there and available, but we would always advise you to speak to your accountant about this. And then overall, improved cash flow. So with the regular predictable payments made, it's easier for companies to budget and manage their cash flow effectively. Next slide, please, Ed. Okay, so what I really wanted to use today was some real life examples here, because ultimately bringing something to life where we've worked with our local customers, hopefully you can see how this may be able to benefit your business. So as a business here in Ignition, we've been very focused on green energy for some time now, for nearly up to 2 years. And it was important for us to support businesses to provide finance solutions to help their businesses be more sustainable. So this example I'm going to talk through first of all should demonstrate part of how we've been able to assist with some green energy solutions. So a local customer of ours down here in the heart of Cornwall, Cornish Premier Pasties. For those of you that enjoy a good pasty, they are the 4th largest pasty manufacturer in the world. They're a well-known brand in Cornwall, and they're part of the Fast Growth Company, and have also part of their growth strategy was important to the client to reduce their carbon emissions. So where we've been able to assist them here is we provided a facility of £135,000 worth of asset funding for 320 solar panels to be placed on their premises. In this example, the customer is saving 50 tonnes of CO2 per year, which is significant there. And we have tailored this around a 5-year funding, which fits in line with their around 5-year payback. And we say around 5-year payback because that is the time period that they have been given by their supplier of the solar panels for when their payback will be. Of course, that's all very much dependent on daylight. It can be much sooner. And what's also important for me to add is that funding can go beyond 5 years as well. And it can be from as little as a much smaller project all the way up to much larger projects. And here what we've noticed is that over this time that green energy has become a huge focus, more and more of our funders, including ourselves as a lender, have become more and more on board with providing financial solutions around the asset finance, not just for solar panel, but for all green energy, heat pumps, etc., wind turbines. So hopefully that's given a bit of a example of how we can help around the green energy and renewables side. So I'm just going to move over to something slightly different as another way of showing how we can demonstrate how we can help. So Brooklyn Sand and Aggregates Limited is a very long-standing customer of my own. Now here we're very much focused on the relationship with the customer. We're not just a transactional business whereby we can just deal with an asset and never deal with a customer again. We really like to home in on creating a proper long-term business solutions for that customer and a relationship. And what I wanted to demonstrate here is that when I go and I sit down and we see our customers, we want to find out what are they looking at for the next 12 months? How can we support them to ensure that we can give them the peace of mind that funding solutions are in place with them for the good long term? So in this example here, I provided a £1.5 million credit line facility, and we put it in place for 12 months, but that doesn't mean it gets taken away. It just means that it's renewed at that time. That credit line then enables the customer to have the peace of mind of knowing they've got this ready. So as soon as they need to purchase a machine or react to a contract and they need the asset readily available and they need to buy that piece of machinery, they can do that. They don't have to wait for an application to go through, and they can be really quick and reactive with it. It's also important for me to note that it's not just covering new equipment. We also cover used equipment across the board. And in this particular instance here, and what the picture would demonstrate, I am in this picture, if you can notice me, it just shows you the sheer size when I was talking about how far up we can go with large plant and machinery. And this actual credit line provided them with 6 machines over that year's period. So in summary, hopefully today I've been able to just give you a few examples of how asset finance may be able to assist your business. And I will pop you back to Lloyd unless you have any questions for me, Lloyd.
No, I think we're probably going to save the questions for the end there, Nicola, but thank you very much. I think in the interest of keeping things moving, that was really good. Thank you. And
You're welcome.
I loved that. I loved hearing about that sort of credit line, which enabled the business to act in a very agile way and take advantage of the opportunities that comes its way. I think many of the businesses in the room would be able to relate to that sort of empowerment that must bring to that business. So that's really good. Thank you. Really interesting to hear that. Let's move on and hear from Ant at Optimum Finance, and he's going to talk to us around invoice finance, how that works, what it is. So without further ado, over to you, Ant. Thank you.
Thanks a lot, Lloyd. So you just mentioned empowerment. I just wanted to say a huge thank you to British Business Bank for Business Finance Week and events such as this. I really do think that this will empower businesses through knowledge and understanding of alternative funding types that could potentially propel businesses forward, or even just navigate the challenging times that many are facing at the moment. I'm particularly passionate about it, so really grateful that you've invited me to talk today. Ed, can we move to the next slide, please? So yeah, I'm Ant Pearce. I'm the Chief Executive of Optimum Finance. Lots of credit background, probably too many years to mention, both in trade credit, but also funding credit, being associated in some form with most forms of funding. But my real passion, which is not going to come as a surprise, being the Chief Exec of a specialist invoice financier, is invoice finance. So I'm the Chief Exec of Optimum. Optimum has advanced over 800 million to UK SMEs. That's throughout the UK. And we've got a very broad sector spread. Can we move to the next slide, please, Ed? So I always say to people that businesses don't fail because they're not profitable. They fail because they run out of cash. So it's really unsurprising that many business owners face anxiety, stress, depression around cash flow issues. And it's also unsurprising, noting that the primary source of cash comes from the proceeds of sale, that they spend a significant amount of time and effort chasing payments. And you can see here that there's 900,000 hours is quoted every day by UK SMEs chasing payments. Now that's an administrative burden for a business owner and means that they're not necessarily concentrating on probably what they do best, which is running their business. Can we move to the next slide, please, Ed? Now, unfortunately, I think that that number is going to become even more prevalent. So here we can see that insolvencies are already starting to spike, and there's an expectation that these will increase into the next year. Now, that means that when insolvencies spike and you see businesses go into an insolvent position, it could leave SMEs with potential bad debt. When there's a bad debt, it puts more pressure on cash flow. When there's more pressure on cash flow, it means they have to spend even more time and effort chasing payments. Can we move to the next slide, please, Ed? But not only do increases in insolvencies result in more time and effort being spent on chasing payments and administrative burden, it also generally means that there's a lower credit appetite from funders to facilitate cash into the SME world. And here's a graph from the BDRC that highlights that between Q1 22 and Q2 23, that the number of declined applications for funding reached 51%. I'm going to pause for a second because that's a huge number, especially when we consider that in the pandemic times it was at 12% because everyone was being able to access CBILS, BIBLs. But even before that, so even before the pandemic, we were seeing decline rates of just 20%. So that's a significant increase, and will give you a flavour of appetite for funding. Can we move to the next slide, please, Ed? However, invoice finance bucks the trend. So the appetite for approval rates for invoice finance is over 90%. And I believe that if more businesses understood it, more businesses used it, we could effectively, just if SMEs used it more, we could unlock £150 billion into our economy. So imagine the impact that that could have. I think it would be incredible. Ed, can we move to the next slide? So what is invoice finance? Well, effectively, it's a way of unlocking the cash that's trapped in your receivables or in your unpaid invoices. So what happens is an invoice financier, they don't really lend you money. What they do is they buy an asset from you. They buy your receivables, which means that if you've got an invoice that you're not going to get paid for 30, 60, 90 days, you could get paid on day one. So it gives you peace of mind that you're going to get your cash straight away. There's also added benefits to invoice finance. So not only do you get the cash flow, the administrative burden that I mentioned earlier around chasing payments, allocation of cash, and all of these types of things are often picked up by an invoice financier. There's other solutions that come with it. So you can also protect your invoices or protect yourselves against non-payment through debtor protection solutions. It's also a product that will grow and shrink with your business. So it works for startups, it works for large organizations and growing organizations. And it's I just want to flag it's not a debt instrument, so it doesn't create additional debt on your balance sheet. It's, like I said earlier, it's just a purchase of an asset. And there's a quote on there on this slide. So I found it quite interesting when Nicola mentioned the company that was selling pasties. This is a company that sells Chinese pancakes. 1 billion pancakes these guys have made, and we've managed to support them within their growth, which was fantastic. Can we move to the next slide, please, Ed? So how does it work? I've tried to summarize this in 4 simple stages. So stage 1, an SME would provide goods or services to their customer, and that customer then is not due to pay them for, say, 60 days. On the same day, so this is all in day 1, same day they create an invoice and they issue it to that customer. But they assign that invoice to the invoice financier. The invoice financier will then advance up to 90% of the invoice value back to the SME. So all of that is on day 1, just by delivering goods and services and creating the invoice and assigning it to the invoice financier. Then on the due date, in this example, 60 days, the customer to the SME will pay the invoice financier, and the residual 10% less the invoice financier's fees become available to the SME. So it's that simple. Can we move to the next slide, Ed? So I mentioned fees, and always get this question. So there's 3 key fees with invoice finance. The first one is a service fee. So effectively for the service provision of all of those good things that an invoice financier provide around the credit management, the collections, the allocation of cash, etc. Now that's a percentage of turnover, and that can be as little as, say, 0.2% up to, I've seen it at 3%. Now that is very high. That's not sort of where our business is, but that just gives you a flavor of where the service fee could be. The next one is a discount charge. Now this is effectively like an interest rate for the funds that are currently outstanding by that organization. And again, you'll see this from anywhere between, say, 2.5% above base. And that again can go up to not that high, I'd say about 4% above base. I've seen it with alternative providers. And the third fee would be around disbursements. Now, this is really when there's an event that has happened or a client has asked for an additional service that falls outside of their normal facility. Can we move to the next slide? So what do people use invoice finance for? So these are just examples of some of the things that our clients use invoice finance for. So firstly, this is all about working capital and cash flow, this session. So it's about driving working capital. But then it's also about investment. So that can be investment in assets, purchase it. So they actually use our funding to purchase assets. They can also use it to purchase tech to drive their business forward, all about driving growth for those organizations, to bring new resource, new blood into the business, maybe new operations teams, new salespeople to help grow it. For reach, so marketing. We also help lots of individuals buy businesses by unlocking cash that's trapped in the receivables, using the liquidity from the receivables to actually purchase businesses through a management buyout or a management buy-in. Out of COVID, we're helping lots of businesses with refinancing. So we help them repay their CBILS or BIBLS loans. Paying back creditors, so that can be trade creditors, HMRC deferrals. If they need to access cash with support with that, we can help with that. And also to pay wages. Now, this can be direct wages within a business, or it can be, we help lots of temporary recruitment businesses to pay temporary labor. And last slide, Ed. So that's me. I tried to get a quick whistle stop for you guys. Hopefully that's been of interest.
That's great, thank you. I feel like we're really laying out lots of options for attendees today, so it's really good. And going from pasties to pancakes was a nice bit of alliteration as well. Very good. So we've had a quick question before we move on to Louis Spencer from NatWest. We've had a quick question about availability of the slides today, because obviously they're really high value for those people listening in to take a look at those after the event. And so we can make the slides available later. What will happen after the event is you'll receive a follow-up, very, very short survey, a couple of questions really. And when you're replying to that, there'll be the option to opt in to receiving communications from us. So if you tick that you're happy to receive that, then we're able to send you the slides. So that's the answer to that question. Now let's move on. And our last speaker of the day before we get to the Q&A, Louis Spencer from NatWest. Thank you, Louis.
Hi, Lloyd. Thank you for this. Can you hear me okay? I had a bit of trouble just logging in. So
Yeah, we can hear you great, Louis. I know you had the tech challenges to overcome this morning, so thank you for persevering, and you're coming through loud and clear.
well done. No, thank you. And no, thanks for inviting me to talk today alongside a really good panel of speakers, actually. And it's sort of quite fitting that I think this goes last, actually, because I think the current speakers have done a really, really good job of explaining asset finance and invoice finance, and I guess some of the merits of using alternative funders other than banks, really. So definitely adding into that financing ecosystem. I'm going to whip through, so really conscious of time, Lloyd and Ed, I'm going to whip through overdrafts and trade. And I was fortunate enough, actually, to attend the Scale Up Institute annual conference on Monday, and I did spend some time the week before with UK Export Finance, who are trade financing lens, the week before that. And in the lead into this, I changed these slides so many different times, and I got to Monday night and I changed them again. And why did I do that? And one of the perennial issues that we see as a bank, and I think the other speakers have alluded to it too, is that you know, finance and finance in general is a barrier to growth, and just general sort of financing needs as well, aside from growth. But equally, what feeds into that is education and sort of democratizing and socializing knowledge around, you know, how do banks and funders come at structuring these things. And so I've just pulled together 5 or 6 slides that feels like it jumps about a bit, but it really sort of lifts the lid on, I guess, the way that banks and funders might look at working capital facilities, and in particular overdrafts and trade finance facilities. So that's a bit of the, you know, high level context of the next few slides. So thank you, Ed. We'll get into this. Hopefully not too much of an introduction needed, really, in terms of our commercial banking presence across the United Kingdom. I've just sort of given your audience a bit of a feel for how we're stood up today, actually, really. And so I think over the past few years, we've seen, you know, banks really consider the way that they support their customers. And I guess I'm really proud to work for a bank that I guess is really invested in and doubled down on its relationship management proposition. And so, as you can see there, in terms of parts to that proposition that we have really invested in, you know, we've got an accelerators across the UK. We've really built out our debt financing capability to that growth and early stage style business, whereas a lot of our peers might still be focusing on sort of more established businesses. But I'll move on from that and probably pick up questions on any elements of that in particular afterwards. So today, thank you, Ed. Today we'll be covering 3 things in a very quick succession. So I thought it might be useful, actually, just to share how a bank might come at sizing an overdraft facility. So you know, the panel have done a really good job of coming at, you know, asset finance and invoice finance. I thought I would show you a bit of a starting place as to how a bank might view a sizing of an overdraft facility. We'll then go on to UK export finance really, really quickly, and we'll pick up some elements and characteristics of trade finance facilities, which, again, I just think is useful to sort of democratize and socialize, really, and again, some best kept secrets there. And then finally, you know, and I think you know, the other panelists have sort of alluded to some of this as well, but I thought I'd just share some personal hints and tips, really, around engaging with banks and funders and sort of what good looks like to us, because I think that can always be helpful as well. So thank you, Ed. I won't propose to spend too much time on this, really, other than just sort of draw your attention to the sentence below the heading there, the working capital. And banks have quite a defined view, and you won't be surprised to hear this, by the way, but banks have quite a defined view on what they would consider to be working capital. And so when banks sort of look in on, you know, working capital needs, you tend to find that, you know, they're quite specifically talking about movement in stock, movement in trade creditors, movement in trade debtors. And that forms the basis for us to size facilities that are linked to working capital needs. And so, you know, what does that look like and feel like? And so this is a bit of sort of accountancy / planning 101 here, but there's a few sort of formulae that people can use to map an average need for their working capital year on year. And this is probably what I would describe as sort of a base level or a starting place for banks to begin to, you know, consider what this funding gap or working capital gap might look like and feel like. Just a few caveats to that. And again, I'm happy to pick up questions directly on how we come at this in a bit more detail later on. But the few considerations to that, of course, you know, these annual, so the 365 there relates to days in a year, of course. And these types of calculations can be skewed by, you know, big ticket suppliers, big ticket customers, and potentially even just shorter term sort of cash needs really that fall outside of a more sustained and structured approach to this. So I'll leave that there and move on. Thank you, Ed. This is just a slide that I guess if you're a visual person like me and you sort of run these calculations, this is what, you know, a working capital cycle can look like and feel like, and actually be presented to a bank actually. To be fair, you know, this is you know, this is a super sort of helpful way to present, you know, your own business to a bank or any funder indeed. These are just some outputs of a I think, what have we got there? We've got a spare parts business. So, you know, you've run those numbers based on the accounts and your management information and annual accounts that you've gotten already, and it's just spat out there the difference between the timing of when goods are coming into your business, how long you're holding on to them for, and then the difference between when you are paying your suppliers and when your customers are paying you. So, you know, fairly straightforward to follow through, and I'll allow you to sort of pick through that, you know, at your own pace later on, and again, invite questions on that after. So very, very sort of whipsaw approach to sizing overdrafts there. Thank you, Ed. Next one. One of UK government's best kept secrets actually, and they've got a fantastic team at UK Export Finance. Why am I raising this? I think on the whole, a lot of our customers have some base knowledge or understand that there are government sponsored support schemes out there, but there are a few sort of myths really attached to the way that these schemes operate, especially with reference to eligibility criteria. So I thought I'd spend just a very quick minute or two just highlighting, you know, one or two things in relation to these schemes in particular that people may not have sort of known about. And so very, very quickly, the pink, draw your attention to the pink highlighted areas there. So, you know, UK Export Finance, and therefore by proxy any bank, can fund supplier invoices, can fund confirmed purchase orders. They can also support with insurance and guarantees. So, you know, a raft of support available there over and above, you know, an overdraft facility, which actually can be sometimes quite a blunt tool to come at some of these working capital issues. The scheme's been stood up to support on a security sort of guarantee basis. So the bank benefits from a government guarantee, not the business itself, but the bank would benefit from a guarantee where if it couldn't lend conventionally, of course, with government support, it might de-risk that transaction to a point where, you know, the bank is now comfortable to lend. So businesses don't benefit from that. So that's often a common misconception. Did you know that actually you could use and unlock export finance support generally? So again, a big misconception from the type of support available to businesses through UK Export Finance is that it has to be linked to a contract, and an export contract in particular. That isn't the case. So there are general financing. Is general export facilities is probably a sort of a poor semantically designed name really, because what that should say is general financing facilities for businesses that export, and that scheme is available to businesses that, as long as they have a minimum, I think it's actually just 5% of export revenues, they're able to potentially unlock government-backed support to support with their general working capital needs, right? Who knew? And then the other, again, big misconception is, as long as the output of your product or service that you're delivering to your sort of chosen markets has that element of export embedded within it in terms of the supply chain, UK export finance can be deployed to help importing goods and or services as a part of that cycle. So again, who knew? So I thought I would just share a few bullets there. Why is that relevant? Thank you, Ed. Next slide. You are looking at a very small portion of a facility document to a customer that we've supported here in the west of England, who were a promotional merchandising product distributor for Disney. So really, really interesting business. They had that license agreement through EMEA. So they were dealing with some really super big corporates, and one of the biggest issues that they had actually was paying their suppliers, so mobilizing factories in China to deal with these really big ticket orders, and they needed to move at speed to do that. But equally, they didn't necessarily have an invoice to hand, right? And so we just, heard from Ant there at Optimum around, if you have an invoice, you can unlock the value of that. But actually, what happens if you haven't raised an invoice yet? And so, there is a capability in essence to unlock value from confirmed purchase orders. So almost that pre-invoice finance and that shipment part of a working capital phase, banks can unlock value from that. And so it tends to be quite a structured approach, as you can see. So there's a bit of governance wrapped around, how we would advance those monies. But if, in essence, what you're looking at there, and I'll draw your attention to the very bottom sort of pink highlighted slide there, we can advance up to 85% in this instance of the value of the confirmed purchase orders that this customer had received from multiple divisions of a really big corporate that were spread across Europe. They had an indication of the amount they were going to buy, and so we were just taking our customers' view on likely unit numbers and advancing against that. So really, really innovative and pushing risk appetite, really, I guess, so to speak. And so I just thought I would share that capability that most banks should be able to deliver solutions like this. And there may be, again, eligibility criteria and de minimis levels of facilities that apply to this, but again, not very well known, actually, I think, in the commercial sort of financing and mid-market space. Thank you, Ed. And then finally, I just thought I would share some pearls of wisdom, really. And I think that, the panel already has alluded to, some of the things you can do to engage with funders. But I think these are probably universal and not just the bank. And so I'll just pick through these very, very quickly. Engaging with, your funder or your bank early on in the cycle. So if you think you have a need 3 or 6 or 9 or even 12 months in advance, actually commencing that engagement, here and now is always super helpful. I think any funder just values a line of sight onto things, and the panel today talking to the value of a relationship approach and being aligned not just operationally around financing needs, but strategically as well. You'll find a lot of funders find value in understanding that, and it does form a really good and important part of credit decisions on the whole. So that's super important. Bring in your advisors. So if you find yourself snookered on some of these things, or it's a bit technical, actually, it's a big plus to a bank or a funder that you might bring in your accountants or a non-exec director on some of these things, right? Really, really good idea to include them if you need help. Management information and reporting. Can't stress enough, really, I guess, the quality of management information and your ability to report that to a bank or a funder. Super valuable. And so those that use cloud accountancy packages and can run these reports around not just their own management information, but potentially some of their own KPIs and OKRs and things like that, again, super valuable for a bank to have a line of sight onto. So make sure you can do that sort of as easy as possible. Management case versus base case, what do I mean by that? It just means that, of course, you know, as an owner manager, a founder, a CEO, a CFO of a business, it means that you will have a view that you're presenting to the bank around what your need might look like and feel like. What does base case mean? Of course, that's just a sensitized or a scenario analyzed view on, you know, what happens if revenues dip 10 or 20%? What happens if my major customer doesn't pay me within 30 days? It's now 60 days. How does that impact the financing case that you're presenting? I'd just be alive to that. So a lot of businesses sort of neglect that, really. And, you know, banks will typically, if you don't offer them that sensitized view or that scenario analysis yourself, they will make their own mind up on that. And so if they don't work with you on that, so just be alive to that. And of course, the final one for banks around security is pretty well known, and maybe it's one for the Q&A shortly. But you know, when banks ask for security, it's for, you know, a good reason, and it's because banks are the cheapest, most sustainable sort of funders out there, low risk funders out there. And so, you know, when we come to talk about security, it really does have a major sort of impact on your ability to advance funding. And I guess as you go down sort of the growth and complexity curve into sort of a startup and an SME space, it's not unusual actually to have financing applications come to the bank, and, you know, there are elements of that financing that relate to growth, and therefore, you know, do have some element of equity risk attached to that. And so, you know, what I would say is, in the industry probably needs to be a bit more bullish around the way it communicates the need for personal guarantees, for example, or other elements of security, is that, you know, you're really looking to unlock, you know, the lowest form of sort of financing, bank debt, you know, super senior debt funding. And you'll get the pricing that, you know, reflects that. But of course, you know, if you're asking us to come in at a time when there's a little bit more risk in the business, then, you know, the security position might reflect that. That's all. So that's what that's alluding to. And then, you know, business plan and why have they got that sort of struck out, really? I think most bankers will say to you that you actually don't need a business plan, as long as you're able to talk to, you know, what you're doing, and almost bring your, you know, your numbers and your financial information to life, really. I think you know, most banks, and actually indeed any funders, and our panelists will probably, you know, share in this view, is that tend to be really good problem solvers, and actually, you know, they will take that information and be able to present it on your behalf in a way that, you know, doesn't necessarily even require you to put that into print yourself. And, you know, that's their jobs, right? You know, they build proposals for financing across all industries, all sectors, and you tend to find that they might have a bit of their own insight as well, really. So not necessarily needed for you to invest a lot of time and energy in that. As long as you can talk to it, that's the important thing. Ed, thank you. I think that's it.
Thank you, Louis. That's really useful, and some real revelations there before I pass over to Ed shortly to get started on the Q&A, and carrying on the alliteration as well, from pasties to pancakes to pre-invoice. I thought that was fascinating, hearing about the possibilities of getting finance before you've even got the invoice. So really good, and particularly calling out UK Export Finance really is one of the best kept secrets out there, and much more applicable to many businesses than most realise as well. And some interesting comments around business plan there as well. Maybe we'll come back to that in the Q&A later if we have time, to see how other people, other providers feel about that, and what they like to see from their applicants. So Ed, I see we've had some questions coming in, and you've been keeping an eye on those for us. So I'm going to let you pick up the baton now, and get our speakers fully engaged in helping all our attendees get the answers to their questions.
Great stuff. Thanks, Lloyd. Nicola's back, Anne's back. Need Steve to come on as well. These questions are flying thick and fast. This is your opportunity now, as viewers of this webinar, to have your questions answered. We've had some high level information from our amazing speakers. You know, they had a short amount of time, so they didn't go into too much detail. So this is now your chance. I cannot overstate that to any length. This is your chance to have your question answered. We've got a couple already coming in. So the first one, which I've noted down, Steve, this is coming your way. Fastball coming your way. how long does the application to delivery process typically take? So somebody comes in, makes an application, how long before they get the cash?
I think it's fair to say we can turn it around. 4 weeks is probably average. We could do it slightly quicker.
Great.
And I'm going to caveat that by saying that applicants can help themselves. We talked about, clear, concise, got to prove viability, that we get different qualities of information coming through. But if they get bank statements and all the supporting evidence that all of the panel members would be asking for, standard stuff really, if we get that in a timely fashion, we can certainly turn things around 4 weeks max.
4 weeks max. Okay, so
and that's on both the startup and startup loans and on the business loans too.
Yeah, interesting. That's really, really good. What I want to do is I want to expand on that to the rest of you, because that's just a great question to dive into for these businesses. But we have had some other questions, so we'll come back to that. Somebody else has come in. This one, Louis, this is coming straight to you. You said you wanted to leave the technical stuff till later, so we have done. How do you calculate, and what is a good level of working capital? There we go.
Oh my. Yeah, that's a bit of a stitch up there, or maybe I stitched myself up out there. I don't know, but it's a really tricky one, that, and I sort of flashed those formulae up with the best intentions there, but I guess the point that I think your questioner there is looking to unlock is, how do they have some scientific way of calculating that number? And so it is tricky, right? It depends on your revenue model and your suppliers and all those really good things that feed into why do businesses need cash. And so I think that what I did share there was a really good starting point, to be fair. And Ed, again, happy to share the slides afterwards, and I would offer that person, if they want a bit more to save time here and now, if they want a bit more of an in-depth discussion with the benefit of their numbers around what that looks like and feels like, I'm more than happy to do that, Ed. Actually, let's do that. Yeah,
that'd be perfect. That'd be great. Thank you for that, Louis. I'm glad you said that. I didn't have to offer your time myself now, do I? So there we go. That's brilliant.
No worries.
There hasn't another one's coming in here. I'm going to read this one. It's quite a long one, so do apologise for this, but I just want to make sure I get it right. So, co-founder of a new trading business, invented a small piece of exercise equipment. All right, granted UK patent and won a grant award 70k. All right, so that's just happened. Their current bank, who I won't mention, although telling them that they wanted them to move on and grow with them, told them that they don't deal with startups, so don't help startups. And when asked for a 10k overdraft, after they've put in 20,000, are paying out 70. They're wanting 60 days to get the grant funding back in stage milestones, as well as paying out VAT on every other invoice. So any advice on grants coming in, £70,000, early stage business, startup with a patented invention? Their bank won't support them. I'm going to come because it's bank mentioned. So Louis, I'm going to come to you quickly and then jump around the rest of it.
Yeah. Okay. No, understood. Without more detail, it's hard to be drawn on it, I guess, Ed. But the fact that you stated startup, and I guess banks, as we know, are senior debt funders, so we tend to start from a point of a track record of profitability and cash generation. And so I guess if this business doesn't have that to point to, from a risk appetite perspective, it might be tricky for us to advance funding at this stage. But again, without looking at the detail of that, it's hard to sort of be drawn on it. But equally, that's why we've got Nicola and Steve and Ant here, really, because they do feed into that part of the market. So I'd sort of welcome a bit more of the fully formed view there, really.
No, 100%. I was going to come to Steve. Steve, startup supporting organisation that Swig are. Thoughts on that? Grant winning, early stage business declined or not supported by the bank. This is something you can do.
Yeah, absolutely. Yes. Pre-revenue, always a challenge, because, how are you going to service the debt? And it's about the people, story, what effect we're having. So personally, from a Swig perspective, Swift allows us to look at startups, and there's good and bad on all applications. So it depends. And it's very hard, like Louis says, it's hard to, without the absolute detail and the quality of information. Look, we know that cash flow forecasts are forecasts, right? But you can model them in, 3 ways. Worst case, the expected, and best case. And we can throw numbers around. So, but there's potential if you're a startup, you've got to approach your banks. You've done that. If it doesn't score through, then absolutely people like Swig would want to discuss that with you. There's no promises, but that's the sort of applications that we see daily, weekly.
Perfect. That's great. Thank you ever so much. So I'm going to jump to the other two now. Our other two speakers. I've been making loads of notes, so I'm sure there are more questions to come in. Hopefully, some of these will prompt those. Invoice finance. You gave a great high level. How early can I access this? If I'm a startup business, can I jump on this? Do I have to have been trading? And I take that example that we just had, early stage business, patented bit of tech, looking to sell it. If it's only one-off, it's only a small bit, a small invoice. How low can we go? How early can we go with invoice finance?
So we support startups all of the time. What I would say is Steve made a great point, right? Is pre-revenue means that there hasn't been an invoice yet. So we can't help with that. But in the event that there has been an invoice, we've supported businesses with invoices as low as, a few hundred quid, because this is about getting them on that journey for growth. This whole session is about working capital. And my view is giving people the cash that's needed. It's about driving that cash. That's what we're all here to talk about. So yeah, and if it's a few hundred quid to pay wages for someone or something like this because they're a startup, we can definitely help with that instance.
Perfect. Nicola, I'll come to you quickly. You've mentioned during your presentation asset, and you've got loans as well in there. How hands-on are you with these businesses? If somebody just comes in and says, I want some asset finance, if you don't think that's appropriate and you've got your loan book there, do you really dive and get under the skin to talk through and pick the best option for them, or do you take them at what they say?
Yeah, absolutely, Ed. I mean, this is something that I explained during the case study. So very much a relationship business as opposed to just transactional. So yeah, we've helped many startup businesses. We do that all the time. We're very supportive of it. And just like anything, it's situational. I think in this particular example, it sounds like it's more working capital based as opposed to needing a specific asset to be financed. But certainly we can help businesses with their business critical assets as they set themselves up. And also if they're selling an asset to a customer, we can help that customer as well, of course, provide the finance.
Sure. That's great. Thank you. Steve, we'll come back to you quickly, if I may. We're hearing, if you don't mind me all saying, Louis saying no business plan. With Steve, you were saying business plan. What format are we talking about? Because lots of these early stage potentially businesses, won't know what a business plan looks like, and when they're asked for 18 months worth of forecasts, are we talking an Excel spreadsheet, or have they got to go out and buy, Xero or Sage and have a fully developed accountant set of P&L, balance sheet, and cash flow? What are you looking at when we're talking about those documents and applying for finance?
Yeah, great question. So rationale, we're looking at a positioning document. Why are they doing it? What's the reason behind it? Where have they spotted a gap in the market? There's got to be some detail just to give us, because we'll, like Nick says, we're relationship lenders. So we'll have a face-to-face, whether it's on this sort of type of means or go to their business. And that's what we do. We've got lending managers all over the Southwest. So we go and talk to the business at their place of work. So it doesn't have to be, massive, but it's got to have succinct is good, actually. I quite like that. And we do get sort of business plans at sort of 90 pages, full colour, looking at demographics. And I mean, that's all fabulous. But ultimately, it's got to translate across to for us, a cash flow forecast. If we're lending money, we've got to be able to service that money beyond doubt with all the costs. And, it's a real negotiated sort of process. And we here as mentors as well, I suppose, because not everyone knows how to position. And because sometimes you go to a bank and you'll get a decision based on a credit score. So none of that matters. But for us, it sort of does. So you can bring it to life. But there'll be formats out that you can buy. But to be honest with you, rationale, positioning document, call it what you like. It's just got to explain what you want to do. And it really goes in tandem with a cash flow forecast for us.
Great, that's brilliant. Thanks, Steve. Thank you for that. I'm going to circle back to the question that that was brought up earlier, because it's a good question. And working capital, cash is king, as you said, Ant. So I'm going to come to you, and I just want to press, because I think you said it in your presentation, but I just want to press home on that. Swig, Steve, 4 weeks to finance on average, or as quick as they can move. Invoice Finance, how quickly can these people get the cash in the bank with you?
So realistically, we'd be looking at about a week. But we have done it. We've turned it around a lot quicker than that, as in 48 hours. That said, what I will say is that, through technology, access to open banking information, access to open accounting information, all of this just makes things a lot slicker and quicker. So it can be done quicker than it would have historically. But really, if I was to give a real representation, I'd say, to manage expectations, it'd be a week.
A week, all right, fine. So Invoice Finance a week. Nicola, how long are we talking from conversation, application to cash in the bank, or at least the finance in place?
Well, do you know what, Ed? Because we do with so many providers, they all have different timescales, but we can be as quick as within a day.
Blimey.
And
Right.
then some more larger, complicated, like a large credit line that I talked about earlier, that could take 3 or 4 days. So we're still very quick and very reactive on being able to get the decisions quickly. So it all depends on what it is and where we're going with it, really. But like I said, it is possible to be that quick. We know customers need to sometimes get the sale done really quickly and get it off the marketplace before anybody else gets there. So we need to make sure that we can react to that.
Good. As a side note, this is not a question, but someone's just popped up to say thanks. It's an incredibly interesting session for them. They've had a nightmare with their bank. Who's not here is a different bank, Louis. You'll be happy to hear. But I think you speak very, very well for NatWest. So credit to all of you, and thank you for being here again. Louis, I'm going to come to you quickly. Let's say I'm a business and working capital, things are tough at the moment. I'm potentially having cash flow issues, or I potentially foresee some cash flow issues. I can imagine it would scare me senseless to go to my bank and say, I'm going to be in trouble in the next 6 months. What would your advice be to a business that potentially sees that coming around the corner?
Yeah, no, it's a really good point, Ed, on that. And so, the way that I guess the banking industry has evolved over the past 20 or 30 years, and probably predating the way that, but my involvement. So, I joined NatWest in 2011 in the midst of the fallout of a financial crisis. And so, the best solutions we're able to provide to those businesses that think that are struggling, they are open with us, they're transparent. They provide that, that early sort of sign, really, that things might not be going to plan. And I think that, why do you do that? Why is that important? I think, if a bank is lending you money, or any funder, and this goes to, anyone, I would say that, if you're in a bit of a distressed situation around, cash or earnings, translating into cash, then, they can only help you if they know about it, right? Fundamentally, and actually, you'll spook a bank or a funder if they don't know about it and they hear about it somewhere else, or something crystallizes at the last minute, and it sounds like a Swig and Optimum and Ignition as well, all relationship based approaches. And so we wouldn't I can speak to my customers only, Ed, but we wouldn't really expect for that sort of thing to be sprung on us, right? Because that I guess that level of engagement and the expectation around that as well, there's a professional expectation that our customers, once we're working with them and we're in bed, so to speak, that that transparency remains, right? And we stay in line with them quarterly or monthly, or whatever they need. But some of those things aren't sprung on us. Basically, that's probably the worst thing you could do to any funder, not just a bank, I would argue. So do it nice and early.
Yeah. That's perfect. That's perfect. Steve, I'm going to come to you if I may for this one. You
Yep.
mentioned you've got lots of products there: startup loans, Swift, your own loan book. Does it matter which one the business uses? Do they know? How would they know? What does it mean to them? What all these sorts of, do they have to apply for a certain one, or are you going to get in? To my earlier question to Nicola, are you going to get in there and really talk them through what matters, which one means what?
Yeah, another great question. So we sometimes do co-loans with ourselves. A startup loan, we'll try and push to the maximum 25,000 because it's 6% fixed, very flexible. So, and then we'll top it up with a loan from my side on the growth side. And that could come from, Triodos, our own funds, wherever. And they're all charged the same rate. So that doesn't really matter. But certain like Triodos on the ethical basis, sustainability, there's certain funds that fund really fits an ethical business. And that's what we're mandated to lend it to. So, I don't think that those watching now need to worry about that per se. Bring the problem to us. We want to find a solution. That's what we're looking at doing. We can, of course, Swig would say, and our approach is to look at when there's a banana skin coming down in the future, that actually we're looking at, taking on additional risk, lending more money, but to keep the business trading, to keep people paying rents, mortgages, a shop open in the high street. It's got to have it's got to be viable post funding. But, again, we are willing to engage with customers and just talk through scenarios. And that's what, I suppose we offer with our managers based all around the Southwest. We're willing to do that, spend some time doing it. So just there's got to be a bit of effort put in, and there's got to be something that's fixable. If it's not viable, not fixable, then we'll use every tool that we've got to try and help those customers. That's all I can say.
Great, no, thank you. And I know you're under time pressure, so I want to get this one in there for you just quickly.
Sure.
So somebody comes to you to use invoice finance. Do their customers know they're using an invoice financier? Would their customers think, oh, hold on a minute, why is the person that I'm buying from using this to get the cash up front? Are they in trouble? What?
Yeah.
Do you have issues with that?
It's a great question. So there's three primary products within invoice finance. Okay, so there's factoring, which is where we do all of the credit control activity. That's what's called disclosed. So it's disclosed to our clients' customers. The second one is what we call CHOCS, which is an abbreviation for customer handled own collections. So we're still disclosed to their clients or to the debtors, but our client then will manage their own collections activity. And then the third one is confidential. So it's confidential invoice finance. And therefore, in that instance, the debt is still assigned to us. So we still own the debt, but their customers are not aware. So it's very, very flexible, and we try and work with the needs and requirements of our clients.
That's great. That's really good to hear. So it's sort of similar space to the question that we had earlier around letting the bank know that there's trouble coming over. That confidentiality, I think, is probably quite key for lots of businesses. So it's great that it's offered. Nicola, I want to come to you, and it's a similar question. If you are able to stay on, and it's great. If not, don't worry. The credit line, the finance, if we put it in place and then I don't take it up, or the businesses don't access it, are there any charges to that? Any repercussions?
Well, the great thing about the credit line, Ed, is that there are no charges. So it's not like an arranged loan where you have to pay an arrangement fee or anything like that. It's part of the service we provide when we sit down. We want to understand the business, know what the CapEx requirements are for the next year. We put the lending proposal together and we put that out to whatever relevant funder we feel is best suited to that business. And that's the beauty of being the finance broker, I suppose, and also balancing it with our own lending book. So there are no fees. It's renewed annually generally, or 6 monthly, whatever it is. And that's just normally alongside supporting some management information. And it's as simple as that. And it really does enable the customer to have that peace of mind that they can be very reactive with when they need to go and purchase those assets. And of course, you have no timescale to wait for the finance to be put in place. It's immediately available. So we're able to react, request an invoice, and we can pretty much turn documents around in a day.
Superb. That's great. We are running very short of time, so I'm gonna come to one final question, and I'm gonna bring Lloyd back in for any final thoughts before we close. So, Louis, if I could just come to you. It's a difficult one to ask here, really. With other funders on the line, how do banks, how do you, or how would you view a business that comes to you that's potentially already accessed some Swig Finance and potentially Ignition or Optimum? What's your view on other lenders, other finances already being in there? What's the bank's view of that?
So quite simply, no one will have a strong view, right or wrongly, Ed, right? So I think, again, if you were to wind the clock back, maybe 5, 10, 15 years ago, into early 2000s, the breadth and depth of our financing ecosystem was lacking. So, that was borne out and sort of proven that once credit stopped being sort of supplied through banks, we really struggled, didn't we, in 08? And I think that, the fact that you've got a really sort of diverse offering within the Southwest and probably across the whole of the UK now of alternative financiers, i.e. anything other than the bank, is a massive positive. And so, the bank certainly wouldn't see that as a negative, that the fact that you've raised elsewhere. So again, I come back to this approach around, bankers and funders are really good problem solvers, Ed, right? And so if there's scope to unlock a solution, whether that's a combination of asset finance or invoice finance or both or neither, just because you've got something in place right here and now, it's, reviewing that and making sure what's right for the business here and now. Yeah. So no downside whatsoever, Ed. Yeah. Categorically. So.
Great, that's superb. Thank you all. I'm going to bring Lloyd in for any final thoughts before we go to Barry to close the session off for us.
No, I thank you, Ed, and thank you for running that Q&A session so well. And it was great to see all the attendee questions being answered so effectively, and getting a bit of feedback that people are finding it useful. I think we have covered quite a few options, but I think time is getting tight. So let me hand over to Barry to close today's proceedings. And just one final thank you to everybody again, which I'm sure Barry will do. But thank you.
Thanks very much, Lloyd. Lost you a little bit there, but I think we're hopefully the sound is working for everybody. So it's been an absolute pleasure to be here with you all to delve further into some of the key options for maintaining sufficient working capital. The British Business Bank initiated Business Finance Week for the very reason of bringing us all here today to help smaller businesses like yours to find out more about the ways that finance can help businesses grow. And I'd really like to take the opportunity to thank all our speakers, Nicola from Ignition Credit, Steve from Swig Finance, and from Optimum Finance, and Louis from NatWest, and of course Lloyd and Ed. All their contributions have helped make Business Finance Week a reality. So hearing from our speakers today has helped share key information and options, and we hope this will help businesses like yours understand whether one or more of the options covered today are right for your business when considering finance. We do plan to send some more information as a follow-up to assist you further, and there is a wealth of further information available via our Finance Hub. And as Lloyd said earlier, today's slides will be made available too by registering for follow-up through the post-event survey. And we would say please do engage with the survey. That really helps us give us some good insight on the impact of today. And Business Finance Week continues for the remainder of the week. And I hope you'll be joining some of the other activities across the week. Especially the webinars taking place each day, and there's still the opportunity to sign up on our webpage and come along and join us for those. And indeed, the good news is we will be making webinar recordings available in the coming days, so you can catch up on those too as well if you aren't able to make the events in person on the day. And we do really look forward to hearing how your business journey evolves. So please do stay in touch. And thank you very much for being with us here today. Thank you very much, and enjoy the rest of today and the rest of your week. Thank you.
Thanks, Sarah.
Thanks.